There is a market, vast, invisible, and almost mythic in scale, worth more than $600 trillion. A market so complex that even the people who built it can't fully map its inner workings. A market that nearly erased the global financial system in 2008, when it was less than 1/10 its current size. Back in 2003, Warren Buffett looked at this hidden machinery of modern finance and issued a warning. He called derivatives financial weapons of mass destruction. Most laughed, some shrugged, but history sided with Buffett. Those weapons ignited the fall of Lehman Brothers. They detonated under AIG like a financial nuclear blast, and they pushed the world to the edge of an abyss we barely climbed out of and never truly repaired. Instead of dismantling the bomb, we rebuilt it. Bigger, faster, more intricate. Today, the derivative market has grown into a colossus worth 6 times the entire global economy. And when it goes off, and it will, there will be no bailout big enough to save anyone. Most people don't see this threat coming. They don't even know what derivatives are. But these invisible contracts form the skeleton of every major banking system, every pension fund, every government bond market on Earth. They promise stability, while quietly multiplying risk layer upon layer until no one knows who owes what or who must pay whom when everything goes wrong. This is the story of the market designed to hedge risk, that instead became the greatest source of systemic risk humanity has ever created, and why the next financial crisis will not resemble 2008. It will be worse, far worse. Context: what derivatives really are, and why they terrify economists. To understand the danger, you must understand the deceptively simple idea at the core of this $600 trillion machine. A derivative is a financial contract whose value is derived from something else: a stock price, a bond yield, a barrel of oil, a currency exchange rate, a mortgage default probability, even the weather. If the underlying moves, the derivative moves. You don't need to own the oil, or the bond, or the wheat. You're simply betting on the direction of the move. A derivative is essentially a side bet on the world. It's financial insurance, but insurance you can buy on someone else's house burning down. And in the early 2000s, Wall Street discovered it could insure everything: mortgages, corporate bonds, government bonds, interest rates, currencies, even indexes of other derivatives. Farmers and airlines use derivatives responsibly to stabilize income, lock in prices, and protect against uncertainty. But the derivative market today is not dominated by farmers hedging wheat. It is dominated by global banks, leveraging borrowed money to bet on interest rates, credit risk, and currency movements. Here's the part the public never sees. The notional value of a derivative is often enormous, but the real money a bank puts down is tiny. A $100 million interest rate swap might require only $1 million in collateral. That's 100-to-1 leverage. At that ratio, a price move of 1% wipes out the collateral. A move of 2% bankrupts the institution holding the position. Multiply that vulnerability across thousands of contracts, across dozens of banks. A small shift in interest rates can trigger a chain reaction of failures. This is exactly what happened in 2008. But back then, the derivative market was only $60 trillion. Now it's $600 trillion. Pattern reveal: how derivatives turn local problems into global catastrophes. Most economic crises begin locally: a real estate bubble, a corporate bankruptcy, a currency collapse. But derivatives do something sinister. They connect every institution to every other institution. If Bank A owes Bank B money on a derivative and Bank A collapses, Bank B instantly faces losses. That means Bank B can't pay Bank C, and Bank C can't pay Bank D. It's a financial pandemic, rapid, invisible, and unstoppable. This exact pattern unfolded in 2008 when Lehman Brothers imploded. Lehman held $35 trillion in derivative contracts. When it collapsed, every counterparty, not just in the US but across Europe and Asia, immediately took losses. Some institutions failed outright. Others froze, refusing to lend to anyone they didn't absolutely trust. Global credit seized like an engine without oil. And just like that, a few bad mortgages in Arizona and Florida metastasized into a worldwide recession. Derivatives were the transmission mechanism, the accelerant, the structure that turns sparks into a firestorm. Modern parallel: why 2025 is more dangerous than 2008. After 2008, governments faced a choice: dismantle the derivative machine or let it grow to an even more dangerous size. They chose the second. Regulators passed Dodd-Frank, which added reporting requirements and created clearinghouses to backstop some trades. But Wall Street lobbied hard and won. The derivative market not only survived, it expanded. By 2015, it surpassed $600 trillion. By 2023, it was more interconnected, more leveraged, and more opaque than ever before. The world has also grown more fragile. Interest rates are swinging violently after a decade near zero. Corporate debt has exploded, much of it issued at rates that no longer exist. Commercial real estate is imploding, with billions in refinancing at triple interest costs. European and Chinese banks are wobbling, carrying massive derivative books. Currencies are destabilizing as the dollar's dominance erodes. Every one of these dynamics has a derivative market built on top of it. And when the underlying cracks, the derivative cracks amplify it. What was once risk management has now become risk multiplication, the prelude to a global reckoning. Derivatives were born out of human ambition to eliminate uncertainty, to tame volatility, to outsmart chaos. But in trying to control the world, we built a structure we no longer understand, a structure more vast than any government, more leveraged than any empire in history, and more fragile than the financial systems that preceded every major collapse, from 1929 to the Asian financial crisis to 2008. As we enter the mid-2020s, the question is no longer if the derivative machine will malfunction. It's what will trigger it. A rate shock, a bank failure, a sovereign default, a geopolitical conflict, and whether the world can withstand the cascading fallout once it begins. This is the story of the $600 trillion bomb beneath the global economy. A bomb built in silence, a bomb defended by complacency, a bomb that history has warned about again and again. And one day soon, a bomb that will detonate. The anatomy of a financial weapon. Derivatives were engineered with a promise: to spread risk so widely that no single failure could ever threaten the system. But that promise was built on a flaw. The idea that human beings can mathematically eliminate uncertainty. Every model assumed stability, every risk calculation assumed normal conditions, every stress test assumed liquidity that would always be there. And so the architects of the modern financial system built more and more layers of abstraction. Futures built on options, options built on swaps, swaps built on indexes of other swaps. Like skyscrapers built on top of skyscrapers, each one higher, thinner, and more unstable than the one beneath it. Banks argued that as long as the numbers balanced on paper, no disaster could truly materialize. But history teaches us something else. The more complex a system becomes, the more catastrophic its failure will be when it finally breaks. This is true in engineering, it's true in physics, and it is devastatingly true in finance. 2008 revisited the blueprint of systemic collapse. To see the future, we must revisit the moment the system first cracked. The 2008 crisis didn't begin with derivatives. It began with something painfully human. An entire country convinced that home prices could only rise. Millions took out loans they couldn't afford. Banks bundled these loans into mortgage-backed securities. Rating agencies rubber-stamped them as safe. But the real danger came when Wall Street began betting on these bundles, creating labyrinths of derivatives that amplified every dollar of mortgage risk into tens or hundreds of dollars of leveraged exposure. When the first cracks appeared in 2007, the damage looked containable. But the system was already primed with gasoline. Derivatives were the match. Lehman Brothers had $639 billion in reported assets, enough to appear stable. But hidden in footnotes were $35 trillion in derivative positions, a web of promises and counter-promises stretching through every major financial institution on Earth. When housing prices slipped, Lehman's counterparties demanded more collateral. When Lehman couldn't provide it, trust evaporated. Within days, the entire global banking sector went from liquid to frozen. Lehman didn't just fall. It pulled the floor out from under everyone connected to it, which was, essentially, everyone. But the lesson the world learned was not stop the machine. It was patch the holes and start the engine again. AIG, when insurance becomes contagion. If Lehman was the spark, AIG was the explosion. AIG's financial products division, once considered a quiet, sophisticated corner of the insurance giant, had sold $500 billion worth of credit default swaps. These swaps weren't protecting AIG customers. They were gambling tickets sold to global banks, hedge funds, and institutional investors. AIG guaranteed that if mortgage bonds failed, it would pay the losses. For a while, those guarantees printed money. Then housing collapsed. Suddenly, AIG owed more than it could ever pay. Its credit rating fell. And in the world of derivatives, a downgrade is a death sentence, triggering immediate collateral demands that spiral out of control. When the bill came due, AIG did not have billions. It didn't even have a fraction of what it owed. The US government stepped in with an emergency loan of $85 billion, then $40 billion more, then $50 billion, then more still. Not because AIG deserved saving, but because its failure would have detonated every major US and European bank. AIG became the world's most expensive warning sign. But again, policymakers ignored the meaning and focused only on the solution. Print money, patch the cracks, pray stability returns. The system was saved, but the message was clear. When derivatives fail, governments do not save companies. They save the counterparties, the entire interconnected system of global finance, at any cost. The false security of clearinghouses. After 2008, regulators tried to fix the system without dismantling it. They introduced clearinghouses, central hubs meant to guarantee both sides of a derivative trade. In theory, clearinghouses reduce counterparty risk. In reality, they created a new problem. They consolidated risk into a handful of institutions that are now too big to fail and too big to save. A clearinghouse failing would be worse than Lehman, AIG, and Bear Stearns combined. Because clearinghouses don't just process trades, they are the trades. Billions of dollars per hour, flowing through servers that assume liquidity will always exist and counterparties will always perform. If even one major clearing member defaults during extreme market volatility, the clearinghouse is forced to absorb the losses. If losses exceed its default fund, it has the legal right to seize collateral from surviving members, even if those members did nothing wrong. This creates a chilling doctrine. The failure of one bank can drain the liquidity of every other bank through the clearinghouse. What regulators saw as a fix may be the catalyst for an even more catastrophic chain reaction. Interest rates, the quiet serial killer of derivative books. The largest category of derivatives, over $500 trillion, is tied to interest rates. For a decade, from 2008 to 2021, interest rates sat near zero. Banks wrote massive derivative positions, confident the world had entered a new normal. Then the Federal Reserve raised rates at the fastest pace in 40 years. Suddenly, the most stable part of the financial system became the most volatile. Long-term bonds collapsed in value. Banks holding fixed-rate assets suffered devastating unrealized losses. Swaps that once protected balance sheets became tearing wounds. Hedged positions no longer hedged. Models that assumed calm were crushed by volatility. We saw the first public cracks in 2023. The failures of Silicon Valley Bank, Signature Bank, and First Republic. What the public didn't see was the derivative damage hidden beneath the surface, losses masked by accounting rules that allow banks to avoid marking these positions to market. The system is absorbing stress, quietly, silently, dangerously. The fragility of 2025, a system waiting for a spark. The economy today resembles something we've seen before. Japan in the 1980s, the US in 1929, Europe before the 2010 sovereign debt crisis. A period of euphoria followed by tightening, until the hidden leverage becomes too heavy for the structure to bear. Every major economic fault line, interest rates, commercial real estate, corporate debt, currency realignments, European banking fragility, Chinese financial stress, has a vast derivative market sitting on top of it. And if any one of these underlying pillars cracks, the derivative exposure amplifies the shock 100-fold. We don't need a mortgage crisis this time. Any instability will do. History doesn't repeat. But in finance, it rhymes with terrifying precision. The cascading dominoes, how modern triggers set the machine in motion. Every financial crisis in history begins the same way, with confidence, with experts insisting the system is stable, with institutions claiming their models account for every scenario. And then something small breaks. Not always the biggest institution, not the most dramatic failure. Sometimes it's a missed margin call, a quiet insolvency, a sudden downgrade, a bond auction that doesn't clear, a bad headline that exposes a hidden weakness. What matters is not the trigger itself, but the way the system reacts to the trigger. And in a derivative-driven financial world, reaction is everything. Because the system is now so tightly connected that any shock spreads instantly, globally, and exponentially. Let's examine the most likely detonators of the next crisis. The ones economists whisper about, but rarely discuss openly. Trigger number 1. Interest rate volatility, the most obvious and most ignored. The first and most immediate spark sits at the heart of the financial system: interest rates. The Federal Reserve has spent decades manipulating rates to steer the economy, but every manipulation carries a cost, and every pivot creates winners and losers. But with over $500 trillion in interest rate derivatives, the stakes today are far higher than anyone admits. From 2008 to 2021, rates hovered near zero. Banks built enormous derivative books around the assumption of stability. Then, in just 18 months, the Fed raised rates from 0% to over 5%. The speed was historic. The consequences were inevitable. Banks holding long-term bonds suffered huge unrealized losses. Pension funds saw asset-liability mismatches widen. Swap positions turned violently unprofitable. Margin calls surged behind closed doors. Liquidity dried up in unexpected corners of the market. The public saw a glimpse of this in the collapse of Silicon Valley Bank, Signature Bank, and First Republic. But that was just the visible tip of a much larger iceberg. The real losses, hidden in derivative books, remain unmarked, undisclosed, and unresolved. And if the Fed pivots again, cuts too fast, raises unexpectedly, or flip-flops under political pressure, the volatility alone could detonate the system. Trigger number 2, the commercial real estate tsunami. A second trigger looms like a slow-moving earthquake: commercial real estate. From 2024 to 2026, over $2 trillion in commercial mortgages must be refinanced. But rents are falling, occupancy is falling, office buildings are emptying, malls are dying, and interest costs have tripled. Most properties simply cannot support the new debt. Defaults are coming, tens of billions worth. On their own, this is painful but survivable. But on top of derivatives, it is catastrophic. Credit default swaps tied to commercial mortgage-backed securities will trigger. The institutions that sold protection, often banks, insurers, and hedge funds, will owe enormous payouts. A single failure here won't destroy the system, but dozens at once, across multiple institutions, that's when the network begins to fracture. Trigger number 3, European banks under pressure. Europe remains the most fragile region in global finance. The collapse of Credit Suisse in 2023 was a warning shot, a reminder that even century-old institutions can fall almost overnight. Deutsche Bank, carrying over $40 trillion in derivative exposure, has faced periodic credit default swap spikes, signs that markets question its solvency. European banks are deeply interconnected with US banks through derivative contracts. If a major European bank fails, American banks immediately take losses, not because they own European assets, but because they sit on the opposite side of derivative bets. A collapse in Frankfurt becomes a crisis in New York within seconds. In the world of derivatives, geography offers no protection. Trigger number 4, sovereign debt crises in major economies. Perhaps the most frightening trigger is sovereign debt, the debt of governments themselves. Japan carries government debt worth 260% of GDP, the highest in the developed world. For decades, Japan kept interest rates near zero to survive. But inflation arrived, rates rose, and the pressure on the Bank of Japan became unbearable. If Japanese bonds fall sharply in value, or if investors lose confidence in the yen, the derivative exposure tied to Japanese government bonds would explode. The same quiet threat exists in China. Local governments owe more than $13 trillion, much of it hidden in shadow financing. China's real estate sector, nearly a third of its GDP, is collapsing. Developers like Evergrande and Country Garden have defaulted on hundreds of billions. Behind the scenes, Western banks and hedge funds hold complex derivative positions tied to Chinese debt, currencies, and equities. A Chinese financial crisis would not stay in China. It would radiate outward, through swaps, forwards, and credit derivatives inflicting massive losses on global institutions. Trigger number 5. Geopolitical shocks, the wild card. Finally, the most unpredictable trigger, geopolitics. A war between China and Taiwan would halt semiconductor production, crippling global supply chains and triggering extreme market volatility. A widening of the Ukraine conflict could destabilize European energy markets again. A Middle East escalation could send oil to $200 per barrel. Each of these events would produce volatile price swings that ripple through entire categories of derivatives. Commodity swaps, currency forwards, interest rate futures, credit default swaps on sovereign debt, index options tied to global equities. Even a small mispricing during these swings could bankrupt a major institution. And once one fails, the chain reaction begins. The clockwork of collapse. What actually happens when the system breaks? In a derivatives-driven crisis, events unfold with astonishing speed. Within minutes of a major default, margin calls surge, counterparties scramble for liquidity, hedges fail, volatility spikes, clearinghouses demand more collateral. Within hours, banks begin hoarding cash, credit markets freeze, central banks issue emergency statements. Within days, government bond markets become unstable, equity markets plunge, pension funds face existential losses, money market funds break the buck. And within weeks, global trade slows, unemployment rises, political systems fracture, central banks face impossible choices. The entire journey from initial shock to global panic happens faster in a world where value is no longer anchored to real assets, but to trillions of invisible derivative contracts. This is not speculation. It is observable fact. The blueprint of 2008 scaled up tenfold. The modern financial system, too big to fail, too big to save. In 2008, the world assembled a $29 trillion response to save a $60 trillion derivative market. Today, that market is 10 times larger, and the governments that once bailed out the system are now drowning in debt themselves. They can't borrow more, they can't tax more, they can't print more. Not without destroying their currencies. The old playbook cannot be used again. When the next crisis hits, policymakers won't be deciding which institutions to save. They'll be deciding which ones to let die. Not because they want to, but because the scale of losses will make saving all of them mathematically impossible. The cascade begins, how a single failure unravels the global machine. If the modern financial system were a massive cathedral, derivatives would be its stained glass windows, intricate, beautiful, interlocked, and unbelievably fragile. The next crisis won't look like 2008, where one bank fell at a time. This time, the world is wired together so tightly that the collapse won't be linear. It will be instantaneous. A downgrade, a default, a spike in volatility, a mispriced swap, a failed bond auction. One spark, any spark, is enough. The moment a major institution cannot meet its derivative obligations, the chain reaction accelerates. 1. Counterparties demand collateral. 2. Collateral evaporates within hours. 3. Margin calls surge across the entire system. 4. Banks begin dumping assets to raise cash. 5. Markets fall, making the liquidity crisis infinitely worse. And here lies the irony. The very instruments designed to manage risk now multiply it beyond control. A localized issue becomes a global problem in the time it takes to refresh a trading screen. The clearinghouse conundrum, the new one ring of finance. After 2008, regulators believed central clearinghouses would prevent another catastrophic chain reaction. But they created a different monster. Derivatives that once linked thousands of institutions together in a messy web are now funneled through a handful of clearinghouses. On paper, this reduces risk. In practice, it creates the ultimate single point of failure. If one major clearing member defaults, JP Morgan, Citibank, Bank of America, or Goldman Sachs, the clearinghouse must absorb the loss. If the loss exceeds its default fund, it can steal collateral from every surviving member, legally and instantly. This means a failure at Bank A drains liquidity from Bank B, which triggers margin calls at Bank C, which forces asset sales at Bank D, which destabilizes markets for everyone. This is financial nuclear fission, the splitting of one failure into thousands of failures. The system we built to prevent collapse may be the very system that guarantees it. When the world realizes there is no balance sheet big enough, central banks saved 2008 by becoming lenders of last resort. They created liquidity from thin air. They backstopped every systemically important institution. But in 2025 or 2026, the arithmetic simply doesn't work. You cannot print $60 trillion. You cannot insure $600 trillion. You cannot backstop losses that are greater than half the world's GDP without detonating the currency system itself. This is where economics meets physics, where mathematics becomes destiny. 2008 was a fire. 2025 will be an inferno, because the world cannot unify behind another coordinated bailout. Debt levels are too high, currencies are too fragile, political systems are too polarized, public trust has evaporated. Inflation has already strained the limits of central bank legitimacy. In 2008, the world saved the banks. In the next crisis, the world will be forced to choose between saving the banks and saving the currency system. It cannot save both. The social collapse, what happens when trust disappears? Money isn't real, not truly. It is a shared narrative, a collective agreement that numbers in a database represent value. Derivatives, however, are promises stacked upon promises, abstractions layered upon abstractions, belief multiplied by leverage, and when belief breaks, everything breaks. The danger of the next crisis is not just financial, it is institutional. The public will ask, why are we bailing out trillion-dollar institutions again? Why are taxpayers covering the losses of derivative gamblers? Why are the people responsible never held accountable? Why do rules apply selectively, harsh for citizens, lenient for banks? The political consequences of another bailout would be explosive. Mass protests, bank runs, capital controls, currency devaluations, populist movements on both ends of the spectrum, collapsing trust in governments, central banks, and financial elites. For centuries, societies have survived recessions, depressions, and panics, but no society survives the collapse of trust in its institutions, and derivatives, by design, are trust machines. When trust breaks, the machine stops functioning. A civilizational paradox. Our obsession with control creates chaos. Why did humanity build a $600 trillion derivatives market? Why did we multiply risk instead of eliminating it? Why did we trust mathematics to control uncertainty that mathematics could never truly predict? Because derivatives offered the illusion of control. Humans crave certainty. We seek predictability. We want safety in a chaotic world. Derivatives gave us a way to feel in control of markets we could never truly master. But every time we hardened the system, we made it more brittle. Every attempt to prevent risk injected more hidden risk. Every safeguard created new vulnerabilities. This is the paradox of modern finance. The more we try to engineer stability, the more instability we create. We built a financial Tower of Babel. We assumed it would touch the sky. We forgot that complexity itself is a form of fragility. The approaching reckoning. What happens when the bomb detonates? When the derivative structure finally breaks, the world will witness counterparty failures within hours, clearinghouse distress within days, central bank emergency measures, liquidity shortages in sovereign bond markets, forced liquidation of assets globally, pension losses unlike anything in history, bank runs as trust collapses, governments imposing capital controls, international trade slowing to a crawl, central banks creating money so quickly that inflation becomes uncontrollable. This will not be a financial crisis in the traditional sense. It will be a systems crisis, a breakdown of interconnected architecture so vast it cannot be isolated. 2008 was a test. The world barely passed. The next crisis will be the real exam, and the answers that worked before will no longer be available. Humanity at the crossroads. What comes after the fall? When the dust settles, nations will have to confront fundamental questions. What does a financial system look like without extreme leverage? Should derivatives be limited, banned, or tightly controlled? Is globalization sustainable if risks are so interconnected? Can currencies backed only by trust survive repeated manipulations? What kind of world emerges when the old model collapses? Some will argue for decentralization. Others will demand stronger central authority. A few will push for digital currencies and algorithmic monetary systems. Many will simply try to rebuild what was lost. But one truth remains. A system built on infinite leverage cannot last in a world with finite resilience. Derivatives gave us power. They also delivered fragility. And in the end, fragility always wins. The aftermath. when the system outgrows its creators. When a machine becomes too complex for its engineers to understand, too large for its operators to control, too interconnected for any part of it to fail without harming the whole, that machine stops being a tool. It becomes a threat. The 600 trillion derivatives market is no longer a tool. It is no longer a mechanism for risk management. It is no longer controlled by traders, banks, or regulators. It has become an organism, a living, breathing, constantly shifting network that responds to every interest rate move, every currency fluctuation, every political headline, every tremor in global markets. And like all complex organisms, it evolves faster than the systems designed to contain it. Human beings, with our flawed incentives, limited foresight, and need for profit, accidentally created a financial life form that demands stability, liquidity, and leverage just to stay alive. One day soon, the organism will feed on its host. 3 future scenarios. What the world may look like after a derivatives collapse. No one can predict the exact path, but history, economics, and complexity theory point toward 3 possible futures. Scenario 1. The controlled demolition. Governments, seeing the looming threat, may attempt to manage collapse. Debt restructurings, forced write-downs, capital controls, temporary nationalization of failing banks, severe limits on derivative issuance. This scenario is painful, a recession or depression lasting several years, but survival is possible. It is the least bad outcome. History rarely grants us such mercy. Scenario 2. The systemic breakdown. The second future is more chaotic. Multiple major banks fail. Clearinghouses become insolvent. Global liquidity evaporates. Supply chains halt. Sovereign bonds become unstable. Nations isolate to defend domestic markets. Public confidence collapses. This resembles the 1930s or the 1997 Asian financial crisis, but on a global scale, amplified by modern leverage. The financial system would eventually rebuild, but only after a long, dark period of dislocation. Scenario 3. The civilizational reset. The darkest future, rare but not impossible. If enough critical institutions fail simultaneously, the collapse becomes existential. Currency systems break. Hyperinflation undermines purchasing power. Governments lose authority. Bartering or parallel currencies emerge. Social unrest destabilizes major countries. Geopolitical tensions escalate. Globalization reverses violently. This is not the end of civilization, but it is the end of this civilization, the financial, political, and monetary architecture that has governed the world since World War II. Derivatives wouldn't be the sole cause, but they would be the accelerant, the multiplier that turns fractures into shatters. The final paradox: our greatest tool became our greatest threat. Humanity has always pursued control. We built tools to tame nature, systems to eliminate chance, technologies to simulate certainty. Finance was meant to protect us, to distribute risk, to stabilize economies, to smooth out volatility. Derivatives were the pinnacle of this dream, but control is an illusion. Every time we tried to engineer stability, we pushed instability deeper into the foundation. Every time we tried to eliminate risk, we made the system more fragile. Every time we layered complexity upon complexity, we created something no one could fully comprehend. We mastered the art of financial engineering, and in doing so, we built a machine capable of destroying the world we sought to protect. This is humanity's oldest story, retold in financial form. We build wings to reach the sun, only to find that the higher we fly, the more fragile the wings become. The derivative market will eventually collapse, not because of one bad actor, one reckless bank, or one mistaken model. It will collapse because it was built on the belief that infinite leverage could exist in a finite world. That complexity can grow forever without becoming uncontrollable. That risk can be hidden without eventually resurfacing. That systems can scale without accumulating fragility. The next financial crisis won't simply challenge the system. It will challenge our assumptions, our beliefs, our very understanding of what money is. And when that moment comes, as history assures us it will, the world will learn again that no matter how sophisticated our tools become, there is always a cost to forgetting the limits of control. The $600 trillion bomb is ticking, the fuse has been lit, and the world stands at a crossroads between a controlled reckoning and an uncontrollable collapse. The choice we make next will define the future of global civilization.